Hey, what's going on, everyone? It's Deron Bethay here with my partner Vince for the DB Multifamily. We're going to give you the blueprint on everything that's going on right here in the great state of Texas. And I'm talking about the DFW. We're going to be going over to tell you the state of where we at, where the market is going, where we were. And hey, it's going to be a great podcast.
Listen, lock in. This is not about chasing every shiny thing you see. This is about building engines that print cash while you sleep. Every bar is structured, simple, and intentional. I speak in clear steps. Build income, protect cash flow, acquire assets, then scale. I am focused on ownership, leverage, and long-term control. Money moves from work to business, from business to properties, from properties to freedom. I think in systems, equity, and time. This is a training sample for an owner mindset. Stop scrolling for the trend, bring it to a dead end. That is not the path, that is how your cash bends. Every new wave hits, then it fades in a week, but the rent still due and your number's still weak.
All right, so let's jump straight in. And today we're going to be going hard, right? And we're going to be talking about everything that's going on here in DFW. We know that DFW right now is still one of the best markets to invest in, without a doubt. The population growth is still coming in. There was definitely an oversupply these past last year. And right now, there's about 16,000 units projected for delivery in 2026. Half of that, half of 2025 is the lowest in 10 years plus that we have seen it drop, all right, for only 16,000 units. So what are your thoughts on that? Where you think we're going? And where do you see us as, Black Sands, Tri-City, our portfolio, our investors? This is a great time to talk so that our investors, too, can get a great update on the state of the market here in DFW.
Yep. This is how I see it. This is how I'm reading it. I think a lot of investors, especially ones that got into this market in 2020, 2022, are getting burned right now. Either their GP, LP, or wherever it is. They just got into the top of the market. We bought in the top of the market in some of our deals as well. But I think they're reading the market wrong. I think a lot of them are sitting on the sidelines and waiting to see what happens. So let's wait till 27. Let's wait till 28. My take is, me and you used to do stock. I used to do stock investing. You do stock investing. Yep. And what I learned about that is it's never comfortable that when it's the best time to buy. Right. You got to get uncomfortable. You got to get in the market when there's blood in the streets, and that's what we're seeing now. And to your point on your opening comment, Dallas-Fort Worth market only is set to deliver 16,000 units this year in 2026. And for context, the last couple of years, they were pushing out like 40,000 a year. So the supply, they call it the supply cliff. So the supply of new starts, new units coming on market has fallen off a cliff. However, population has not stopped. Even through the economy, even through the slowdown and whatever is happening, over 120,000 people moved to DFW last year, and they're still set to come. 26, 27. The population growth is not stopping, but the new starts have fallen off a cliff. So just in a supply demand, point of view, it's going to get absorbed quick. And we're seeing that as well. Yeah,
and I want to kind of go about a little bit, especially those our investors, which is super important. I want to talk about when we enter the market. We enter the market at the highest point. All right, just like Vince talked about. You can't really time the market. If you can, we all had a crystal ball. We all would be rich. But one of the things that I think that we are super proud of is as we sit back and we see what's happening, not just here in DFW, but across the U.S., all right? There is definitely a lot of distressed assets that are currently out there where loans are coming due. We saw, 2 years ago after COVID, the banks where it's more working with operators, GP operators. And what we're seeing now is that, they have to go. And when we came in the market, our goal has always to be a little more conservative than most operators, be low leverage. Our portfolio is about a 62% LTV that give us the opportunity to operate, but also put us in a position where that, we don't have to rely on a super high break even either, or occupancy. So those that are just watching this, I just want to tell our investors that, right now, there's not a lot of groups that have, almost 1,000 units or whatever, and they don't, and those loans are coming due. We have right now, we're not in a position where we have to sell. Where that right now we are seeing a lot of people having to sell. In fact, we've been out here in Dallas all week. Me, Vince, and our acquisition team. We went to 8 and 9 of the local brokers here. I'm talking these national brokers, and been by the office. And they all saying the same thing. Right here in DFW, there are 17,000 apartments. Of those 17,000 apartments, about 30%, a third of them are currently distressed. And what I mean, the DSCR is under the 1, meaning that they're not making enough to cover the note. So, our goal is not to retreat. Our goal is to tighten up and focus hard, focus on managing, and this is the perfect opportunity. All right, this is where the money is made. We have not seen this market since 2008. This is the last time we've seen the market that we're currently in, where we're seeing discounts. Right now, we purchased last year 3 properties, Lakeside, Enos, and the cottages at Bell Station. About $80 million of real estate, where we was able to get about, about 30% discount. All right. Now we're seeing 70%, distressed assets, value add. And Vince, just give them an update and let them know where are we moving to. Last year we focused on, got some great deals, great buys with A-class, but now we're going back to our old roots, right?
Yeah, exactly. And I want to say going back, it's more so reopening a division or a line that we have since kind of moved away from, which was the heavy C-class value adds. That's where we cut our teeth. We did about a dozen of those from 2018 all the way up to 2023, 24, before we started switching over to the A-class core assets. Now that we're seeing a lot of these C-class assets, and for us, we don't do 70s. So when I'm saying C-class, I'm talking mid 80s or newer, mid 1980s or newer. So we don't touch 1970s product at all. So the mid 1980s and newer product trading at anywhere from 50 to 70% off of its last trade high. That's not a discount. That's a complete reset of the cost basis, and that's how we're looking at it. So we're not moving away from the A-class asset class either, because those are trading at 30% below their last high. So we're running both. Yep. If we find an awesome A-class asset at 30% from its recent high last trade price, we're going to pursue that if all fundamentals are right, as well as reopen the division for the C-class repositions. And I'm going to ask you, why are we more prepared now than we were in 2020 because we have this family office now that we're building? How is that preparing us to really crush it this time?
Yeah, so the number one thing is, obviously vertical integration. We coming together. We got Black Sands, property management. It's all about bringing things that we can control. We have seen we are better than most operators. The more that we have control, Vince and I can control the asset, control the property management. And not only that is to now control the supply, meaning that, I just left, got back. I was in China for 2 weeks, where that we are looking and bringing in building material. So all those renovations, when we're looking at the distressed assets, that costing most groups gonna they write and they underwriting $20,000 and $30,000 for capex. Well, we're gonna be able to get that a way cheaper fraction of the cost. All right, which is gonna give us the opportunity to control the supplies that's coming in. We're going to be able to control the management. And it's also by us setting up the family office with me and Vince. Everything is in-house. We have no third parties from the front to the back. And we also are going to be bringing in construction in-house as well. So as we continue to become more vertically integrated, our focus is to make sure we buy these assets right. We buy them at a discounted price, where that Vince said that, some of the deals that we went out and toured about, I don't know, we have about 20 properties that we're currently looking at, all distressed assets, or they traded from the 30% from the lowest and lower from when they their last cost basis. But everything that we're doing, we are positioning ourselves to really grow and scale. And those investors who our limited partners investors that have been making money, we never lost one investor money. All right, not one. And we really proud of that. And even in this market, if we can make it through this market and we can continue to bring on assets that are 30, 60, 70% discount, we're going to be able to make a lot of money for our investors. So that's great. But that's what I'm excited about, for the family office. It's just not a benefit for us. It's definitely a benefit for our investors, even not just investors, our communities, our residents in our communities and all.
One thing I think the family office is, it's not just a shift in structure, it's a mindset shift. It allows us to be a lot more patient, a lot smarter with how we deploy capital and the opportunities we look at, looking at longer time frame horizons.
Yep.
And that is completely shifting how we look at opportunities. Before, and a lot of other people, they're looking at mainly just through the lens of a syndication model. So they're
Right.
quick transactions every 3 years, in and out, in and out. With the family office shift in the mindset, we can be a lot more patient, a lot more selective. Our underwriting is a lot tighter because we can control the entire process, like you said, cradle to grave, everything from supply materials to management to construction. Asset management is all in-house. We can be really selective on what we go after, and I'm not sure many people out there are going to be able to execute at the level that we bring to the table now in 2026.
Oh yeah, no, and I don't say it lightly. We are the best. When we looking at, I'm not just tooting horns. When we looking at business, and I tell people when I'm on stage coaching or whatever the case may be, when we looking at operators or just business owners or producers, 90% of the United States population, all consumers, there's so 10% that are true operators, entrepreneurs who I love dearly. I got a strong heart for entrepreneurs. I got a strong heart for veterans, especially veterans who have now became entrepreneurs like Vince and myself. But of those 10%, all right, I want to be the 1%, and that's what we are able, and that's what we're definitely focused. As far as talking about DFW, we're still seeing a lot of jobs being created here. This, as far as when we talk about the market and people moving, what's happening right now. All right, for those of you that just watching this, that's thinking about investing into the DFW market, or those of you in DFW, let me kind of give you the lay of the land. All right, we all know that California and New York, a lot of blue states, are starting to relocate or been relocating. That's why we have this huge migration from California to the DFW and from New York to the Carolinas on down to Florida. And what we're seeing is that when all those that growth of people that's moving in, all right, that's moving into Texas, I think it was like 1 million people came in Texas last year, which is phenomenal. They need somewhere to live. But what's happening is, if you look at LA, and I was reading in this, or I was at an event not so long ago, and they said what happened in LA, where you have all the cities in LA where they almost all intertouch all the way down. They're seeing the same thing that's going to happen here in Texas, from Oklahoma all the way down I-35. All right, and we are starting to see it right now. Just in, you have Dallas connecting, going all the way up. You got the Frisco's, Prosper, Solano, Gauntner, all the way down. We already see Temple is already starting to connect with Austin, and Austin is already connected all the way down to San Antonio, San Marcos, as you continue to drive down. So this is the market to be in. Great market. But what is your, let's talk about some of the pockets that we're looking at. Let's talk to them, let them know, hey, like our AMI, for our C-class, our AMIs that we're, our non-negotiables of some of the things that we're looking at as we look at all these properties coming to market.
Yep. For AMI, this was, which is area median income, this was a KPI that we track on our kind of benchmarks when we're looking at an opportunity. And it's like, all right, does it check all these boxes? AMI used to be kind of not toward the bottom, but maybe top quadrant. It is now our number one KPI that we look at.
The only KPI almost, right?
Yeah.
So the population is you don't need to look at too much.
Yep.
So DFW, the hottest market in the U.S.
Yep. So AMI has definitely moved up to the number one screening criteria before we even look at a property, and how the area median income arrived at our number one KPI that we look at is when we brought property management in-house. The aperture, the lens that we look at for perspective of how properties operate in different pockets went pretty wide open, because now we can see firsthand on the ground experience the difference between a $50,000 AMI or $40,000 AMI pocket versus a $60,000, $70,000, $80,000 AMI pocket at an actual operational level. And what we found was even though a pocket that might have a $50,000 or $55,000 AMI pocket might pencil out on a computer screen for a C-class property, operationally, it is very resource intensive. We're going to have to require much more manpower to keep those properties there, a lot more evictions, a lot more tenant collections issues, a lot more just manpower to keep that property operating at the same level of a property a couple miles away that might be in a pocket where the area median income in the 1 mile might be 70,000.
Right.
We're going to need half as much people. The evictions are going to be half as much. The collections are going to be a fraction as much. So resource intensive is going to push us, has pushed us toward increasing our AMIs as our number one criteria, because now we have that operational perspective of not just the asset management, but also the on-site property management as well. So some of the benchmarks we use for our C-class properties are going to be like that $60,000 to $70,000 range.
Yep.
And then as we get into the B plus, A minus A range, we're going to want to see like $80,000 to $90,000 AMI ranges. That resident pool of potential people that are going to be living in that property at those levels is going to drastically reduce the amount of resources required to keep that property performing on the property management side, which our company, Black Sand Property Management, is going to have to put in to manage that property. So that's what we've seen over the last couple years. So that's why that AMI KPI has moved to the number one spot.
Yeah, and one of those things to just talk about too, as far as DFW, 27 straight months of no rent growth, 27 straight months. But DFW still is the number one in the country to absorb. So which is great. Both things are true there. 2026 deliveries are the lowest in over a decade. I'm just reading off some notes here. You can't unbreak that, right? Everything's collapsing. 40 foreclosures in 2025. They say the 8 years before distress isn't coming is already here. Let's talk about it a little bit.
Yep.
Distress. What you like? it's a ton of distress out here.
Every shop we went to.
If you're watching this right now, and it could not be a better time to enter the market, whether you're looking to be an operator or investor. All right, and that's why we here this week, boots on ground here in DFW. Ripping up and down 35, 20, like we all over this place, and we are looking for opportunity, and it's more than enough. And we already here. We got great broker relationships, which was also great. We came in the market. We've been a group known and never trade, easy to work with. So now, they're giving us more opportunity, more first look. This is the time. But talk a little bit more about really like the distress and why this is the opportunity that every investor should be trying to invest in the hottest market in the U.S. Even though all this we talking about sounds so bad, but it's still the best market, best time, and it's going to be an opportunity to make a lot of money. All right, a lot of money. 2x, 2.5, 3 multiples are coming for sure.
One of the things as we did our broker tours this week, I don't know how many we saw, maybe 10 broker shops we visited. All of them are saying the same thing. They've done, some of the notes I took away from that are they've all done more BOVs, which is a broker opinion of value, which is the same thing as kind of like a desktop appraisal before a property is an owner has a property they're looking to sell, so they're trying to figure out what it's worth or what it would fetch on the market. If they went to market with it, the broker would do a kind of desktop appraisal. That's called a BOV. They've done more BOVs in Q1 of 26 than all of last year combined.
Right. Yeah, it's crazy.
And that shows how much people are looking to sell. And not only that, of the amount of properties that are looking to transact this year, most of them are going to be for sales. They're either going to be for sales because the property has already been foreclosed on, or it's in receivership, or the special servicing where the bank or lender is forcing the sale to get the property off their books.
Right.
Because they're losing.
And tell them, like, since we've been in this, we've never been in straight communication with lenders.
Yep.
At this point, that's how much stuff when you're going and talking directly to the lender like we are, that's showing what's happening. We're getting more scheduled calls with these lenders and talking more direct with the lenders because all of the foreclosures.
Yep. Yeah, exactly. Talking directly to the lender, directly to the receivership, directly to the servicer that is in charge of these foreclosed distressed assets and dispositioning them. Many of them taking losses, not just the prior owner getting their equity wiped out, but also the lender taking millions of dollars a hit as well. So a lot of these properties we're buying are millions of dollars under what the note value was.
Right. Give them an example of just, as that one property that we was looking. Started thinking I got the call in Dallas. I think the note was 18 million, came down to 15 million.
Came down to 15. That's what the note value was. So they were trying to, I think it traded for like something like 30 million.
30-some million.
So it traded for 30 million. That's what the owners bought it for. It got foreclosed. The note value was 18 million.
Yep.
They got us. We found out about 18.
They called me in Dubai.
Yeah.
I was in Christmas, $15 million. I'm like, $32 million sold price, 15.
Yep.
And where we was at then? Keep on going.
Yeah.
The story keep on going. Keep on getting gooder.
Yep. So it was at 15 million, and then we get in, we start having serious conversations directly with the lender. By the way, there's no broker. There was a broker, but it was like we were on the call weekly, every Friday with the lender, directly trying to hash this deal out. It was such in a distressed state because the owner essentially walked away from it that the deferred maintenance just kept racking up. The city violations just kept racking up. So we got down to about 11 million.
Right. And when we walked. Decided to still walk because it was burning too much cash.
Yep.
Couldn't make the deal work. Even at 11, we talked about them having to evict all the tenants out.
They were going to go down to 0% occupancy because the deferred maintenance was that bad. And mind you, this property was purchased like 3 years ago. So in 3 years, they went from a stabilized C-class asset to 0% vacancy because they didn't know how to manage right.
So listen, think about that. $11 million buy price, $32 million last sold.
Mm-hmm.
I can do math. It's about $21 million.
Yep.
Right there. 21
vaporized,
million.
yeah.
Gone. Just like those are the operators we got to compete against. You think we're going to let those type of operators operate at the level that we are? Absolutely not. We're going to crush those guys. They're not going to be able to compete against us. That's how I look at it. I want to go in the neighborhood. We're going to want to be the best in the neighborhood.
Yep. And that's not a unique, that's not a unique story. That might have been probably the biggest discount we've seen, but that's not a unique unicorn. Like I said, we visited 10 shops. Every broker had stories like this of properties that they knew they bought a property. They put the wrong debt on it. They over leveraged. They don't know how to manage, and just when the market went, rents like you mentioned before, 24, 27 months of rent declines. They didn't underwrite. They had no cushion, no margin, no operational control, and they just couldn't handle the debt service, and they just walked away from the properties and everything.
And we're saying the same thing. When that's distressed asset. That's an '80s built. But last deal we purchased back in Class A-class asset and signed. Same story. Developer. Time is up. And we talking about new constructions, and I believe we got around about 120 some, maybe like $125,000 a door. You can't build it at that price. So there's a lot of deals that are out there that we are looking to buy. This is the time now because we are starting to see a lot of what we call old money, family offices. They are starting to come in. They've been waiting. When they start buying, that's what we need to come in. We start buying. We just came best and final on a deal, and we lost out on another. Someone that was able to come in cash. They've been out of the market. The last property they purchased was like 4 years ago. They got about 10,000 units. I haven't purchased nothing in 4 years, and they came in with a very strong offer. So you're starting to see groups, the smart family office that have been on the sideline with all this cash, and they are deploying it right now, and they're going to create massive wealth, massive, and that's what we're doing. The same thing, and what you're going to see is you see the family office come in first. They're going to come in first, and the institutional investors have not yet entered the market. All right, the institutional investors, they're going to wait. They're going to come in like the family office. No, Vince and D, we trying to come in here, down here. We don't know what the floor is, but we know we getting a sturdy, great discount. And then next you'll see the institutional. Once the market start to go a little bit, they're gonna still come in. They're still gonna come in and get discounts. But right now, I think we have the advantage here, definitely, with all the vertical integration, with all the relationships, and just I think we're just in a good place.
Yep, and it comes to the basic fundamentals. So buy right, finance right, manage right. On the buy right side, we're focusing on cost basis. All in cost basis of these properties are some of the brokers that we've talked to that were on the older side. They've been doing this for 40 years. They said even 2008 wasn't this bad for a cost basis reset that we're experiencing. So buy right, lock in our good cost basis. Finance right. We do low leverage debt, even though some of these might have to take a bridge, bridge to perm, and we'll refinance at a low leverage perm. When I say low leverage, we're 65, 60% LTV, long-term fixed rate, non-recourse debt. So we lock that thing in on finance right, and then the manage right. This is the part where most other people get it wrong. They're not prepared for manage right. They think they can just hand the keys to a third party and go, drink Mai Tais on the beach somewhere. And guess what? We just took all of our properties back, our very last property back from a third party because they are unprepared to deal with this market. They just, for whatever reason it is, the third parties here cannot execute as well as we can. I have a thesis on that. But the bottom line is that the third parties, if your plan is to use a third party property manager, you're going to need to underwrite much more conservative. Is what we've seen, and we've had 4 or 5 different third party shops here in DFW, and not one of them was able to outperform us. And we've only been doing property management for 3 years,
Right.
In-house property management. So,
Yeah.
buy right, finance right, manage right. Inside the family office, where we can control the full cradle to grave supply chain, there's not going to be many people that can touch us.
Right. So if you definitely, again, if you're watching this and you got money in the sideline, money was in the CD savings, not getting the yield that you want, we are definitely here in the market. All right. And for our investors as well, we're going to continue to bring you to some great deals. Our goal right now this year is to bring on 3 properties. We actively looking at properties every single day, but we'd like to bring 3 properties. And I want to put something in perspective for you too as well. We'll be able to get right now, 3 years ago, all right, if I said we bring on 3 properties, we're looking at 100 plus units, all right? Each property that we're looking, when you get into 200 units, you're going to be somewhere 3 years ago, about $35 million per property. All right, multiply that times 3, all right, you're about right at $100 million. We are in a great situation where we can get 3 years ago what cost $100 million. We can buy the same product probably somewhere around $50 million. All right. And that's what we're looking. We're going to bring in discounted units. If you're watching this, just reach out, to either Vince or myself, someone on our team, so that we could definitely bring you some great deals. You're looking at C class, we got it. You want A class, those coming too as well. What else you got?
I think that sums it up. I'm excited for 26. I'm excited for 27. I think this isn't a flash in the pan as far as supply of these distressed properties. Several of the brokers said it's going to take like 18 months to get through the backlog of these distressed properties. So we have time to really pick the best ones in the best areas, and maybe we grab 10 of these.
That'd be great.
Yeah,
be great. Get 10 for about $70,000, $80,000 a door. Sell them 120 to 150. Yep. So that's a playbook. That's what we're doing. We came in the market where we saw, unbelievable what we saw. We witnessed 1980s trading at 150,000, 153,000, and we watched it fall all the way down from 150 to 115. We watched it go to 110, 90, 80, 70, 60, and we've seen it as low as $50,000.
Yep. And I'll just close with the operators who are going to build the real wealth over the next decade are the ones that have the intestinal fortitude and the courage to get into the market now. When it feels bad, when it looks like there's blood in the streets, now's the time to get in. The ones that wait until wait on the sidelines, so say we'll wait and see, they're going to catch that cap rate compression.
Yep.
And they're going to jump in and try to get the FOMO, in 27, 28, 29, when the cap rates are already back compressing, and they're gonna jump back in, and they're not going to catch these cost bases. So that's what I see.
Awesome. All right. Well, listen, that's all we got. Again, reach out to me, www.durambate.com. And
yeah, you can find me at vincegethings.com or wheelbarrowprofits.com.
Are you looking to become a passive or active investor in multifamily real estate? Or maybe you're at the point where you ran out of cash for not having any systems and processes or the right resources in place. Investing in real estate is an excellent way to start building multiple streams of income, but it can become challenging if you fail to overlook market analysis like selecting the right location, researching the current market trends, and finding the right property management company. You don't have to have a formal education in business or real estate to reach the success you desire. You just need a proven blueprint. Hey, I'm Duran Bethea, and I've been an entrepreneur and an investor since 2003. I started investing at the age of 20 when I was active duty military as a full-time soldier, and now I've created over $100 million in business and real estate assets and currently host Hawaii's largest yearly business and real estate conference. If you do not know where to start, or maybe your investment properties are not profitable, you're not alone. That's why I created the Business and Real Estate Blueprint, a comprehensive course with insights, practical strategies, and actionable tools that can help you build and grow a real estate portfolio. If you're ready to start building generational wealth, click here to learn more.